Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So right now the market is still very volatile. There's so much going on. While Donald Trump is still picking fights with everybody else in the world, the markets will have that sort of uncertainty, which means we get an opportunity for us to buy high quality businesses at discounted prices. We all know exactly what happened in April, where stocks were down so much. People said, you know what, I'm going to sell everything and I'm going to wait for stocks to drop even further, then I will buy it. And then since then, we've gone up quite a bit. So it's really important that as a long-term investor, you look for these opportunities and make sure you actually invest as much as you can in those times where the stocks are down, because that's how you make money. Right? When the stocks are down, and I'm not saying everything is cheap right now, there's so many companies that are overvalued, but I'm going to share with you guys today 7 companies that are closer to their 52-week lows. So that means basically they are closer right now to their 52-week lows because because for a million different reasons, whether it's just the overall markets, whether some of them are affected because of the terrorism things that are happening in the basically in the US, maybe some of them is because really something related to China. So there's so many reasons why these companies have come down quite a bit. I genuinely believe those companies are very good, high quality businesses. So I'm going to share with you guys today. And some of them are still, although they are getting closer to the 52-week lows, they are still a little bit overvalued. So I'm going to share with you guys these 7 companies. And again, if we see massive pullback again in the market, which can easily happen because right now the guy on the steering wheel is not a unstable guy, anything can happen, especially in the US. We might even get another opportunity and so. So let's get started. I don't want to make the video any longer than it needs to be, but there's one other thing I want to say quickly before we start the video, and that is if you have not sent me your portfolios yet, please do so. Okay, I've genuinely learned so much from it. I hope that the feedback I'm giving you guys is actually beneficial. Okay, and all I need from you is just to tell me basically a bit about yourself and as much details you possibly can. How old are you, where you work, basically what your income is, and basically how much you're investing in the stock market, that sort of a thing. And then just give me the names of the companies that you own and how many shares, what percentage of that is your entire portfolio, and then a little bit of comments about why you basically own these companies. And I will give you basically good feedback, inshallah, just to explain every single company. I'll go through every single company and give you my honest opinion on what I think about that company. Again, I'm not a financial advisor, but all I'm doing is just helping the community to see basically this, if there is, like I said in the last video, basically what some people have invested in companies that are yielding basically different yield of like 7%, 6% when they are like in their, I don't know, 23, 24, 25. That doesn't make any sense to me. So that's the type of comments, inshallah, I will be giving you. So yeah, let me know, inshallah, once you have basically sent it to me, then I will give you feedback, inshallah, as soon as I can. And here are the 7 companies we're going to talk about today. We're going to look for exactly the same things that we normally look for. And some of these companies, they pay dividends, so we included that as well. The first one we're looking at today is Home Depot. Home Depot is down quite a lot, so I'll show you quickly. For example, a year to date is actually down about 5%, and it's basically right now the 52-week low is basically $326 per share, and right now it's basically about $367 per share. Basically, it's got 2.5 dividend yield, which is really good. The payout ratio is very, very low, and latest increase was 2%, the 5-year growth rate of 10%, and then basically 16 years of increase in that dividend. You get $9.20 for every share of this company that you own. Dividend safety is 87%, profit margin about 9%, return on equity about 300, and return on invested capital is 24%. Now, in terms of free cash flow, we've got excellent free cash flow. That's about $15 billion of free cash flow. EPS expected to grow about 9%, revenue about 4%, and but right now it's actually expensive. Okay, according to Morningstar, it's a bit expensive. And if we go to fast graph, for example, you can see the earnings have been growing every single year, but the price has been completely mismatched against that basically earnings, if you like. And as you can see here, the next couple of years, There's a bit of a dip in 2026, but 2027 and 2028 is expected to bounce back. If we use the forecaster for this one, we're using the estimates, you'll be losing a lot of money if you bought it right now. And if we use the normal PE for this company, you'll be making about 18% on total rate of return on this company in the next basically next 3 years. And the next one is Adobe. Adobe has basically come down a lot, basically. So year to basically to date is, let's see, 14% for the 1 year, about 33% down, which is absolutely ridiculous. And they don't have any dividends, but profitability is absolutely one of the best out there. Excellent free cash flow. They're expecting the earnings grow about 12%, revenue about 9%, 47% upside from where we are according to Morningstar. If we look at the fast graph, for example, you can see how the revenue has been growing beautifully for the last whatever years, but then look at the price. The price has completely mismatched against that. They're basically against this basically a growth side of things. This is not just revenue, this is earnings, by the way. Now if we look at the forecast, for example, based on their normal PE, you break even right now. If you bought this stock, basically you're not going to make any money according to this. But if you use the normal PE that the company has been trading, which is about 38, which I don't think we should be using, you will be making about basically your 10,000 right now invested in the next 3 years, you would be making 25,700 USD. Now I wouldn't say basically this is exactly what's going to happen. This PE is basically warranted right now based on this growth here. So 2025 we're expecting about 13 to 12%, then almost 13%, and then another about 11%. So for that one I would probably say it doesn't warrant that, but I think it is still got a bit of an upside. It's still undervalued, but I don't think it will be that. Okay, but you still have to be careful. As always, add 10% on that margin of safety. So I don't think you can go wrong with this one here. The next one is Novo, another one that's come down quite a lot. They have excellent dividend. The profitability side of it is really good. The management are doing a good job with their money. Free cash flow over $11 billion. EPS is expected to grow 16%, revenue 14%, 23% upside, $86 per share is where they think the price should be. And for the 1 year, it's down 51%. I genuinely think this is one of the companies people are sleeping on. They genuinely missing out, I promise you, because you're not going to get this chance. Yes, I know there's a bit of uncertainty with the competition and all of that stuff, but I don't think this company is down and out completely. So that's just my opinion, by the way. Historically, let's have a look at that. Look at that earnings growth. Look at that basically price. Absolutely ridiculous, especially when the basically the Ozempic, all of that came up, the GLPs, all that madness, and everything went to the moon. But now it has come back down a lot. And if we just use the forecast moving forward, the normal estimates, we are expected to make about 38% annualized rate of return. And if you look at the normal multiples for this company, you are expected to make 145%. So your 10,000 will become 24,500. Okay, again, another great company. I genuinely love that company. And Accenture is another 188 billion market cap, excellent dividend payer, and profit margins is really good. Free cash flow over $10 billion. Revenue and EPS expected to grow, not great, but it's okay for now, but it seems a bit expensive. The stock is down about 14% a year to date, and looking at the fast graph, if we just click historically, as you can see, look at that growth side of things, and then look at the price, which is absolutely ridiculous. Now, if we look at the forecast moving forward for this company, if you bought it right now, you'd be losing a bit of money, about 10% of your entire money. But if you use the normal multiple for this company, again, it's one of those growth companies that you potentially might have to use the normal multiple, and that basically your 10,000 will become 14,654 USD. The next one that we're looking at today is Qualcomm. Qualcomm is one of the companies I have in my portfolio. It's a great company. It should have a wide moat, like I've always said. Excellent dividend payer. 4 years time, this will become a dividend aristocrat. Profit margin, return equity, return invested capital, one of the best out there. $11.7 billion of free cash flow. Growth is not there right now because it's a very cyclical businesses. One thing you need to understand about semiconductors, they are very cyclical businesses. I was buying this company when it was trading, when basically it had EPS and revenue that are less basically in the negatives, and it's gone up a lot since then. 7% an upside from where we are right now. And for the year to basically for the 1 year, 23% down. A year to date is about 4% up. Now looking fast graph, You can see historically where the company has been, which is quite nice to see. Okay, it's been sort of trading the same side, basically within that orange line, which is quite nice. But then over last couple of years, it's been just all over the place. Now, looking at the forecast moving forward, normal estimate, if you buy it right now, you would be making about 8% and basically per annum. And if you buy it with basically, if you buy it now with a normal multiple, then you will be making your 10,000 will become about 13,109 USD. Okay, the next one that we're looking at today is Procter Gamble. Again, another one that has been in my portfolio for a very, very long time, but I think it's still a little bit expensive in my opinion. Great dividend payer company. This is one of those steady eddy companies that can sit in your portfolio for a long, long time. I'm planning to add to it very soon, so I'm hoping that it comes back down a lot. Is a very defensive stock. Even when the rest of the stock market goes down 5%, it goes down by 1%. But when they go 10% up, it goes up about 3%. So that's basically the the price you're paying basically. But it's a really great company, excellent free cash flow, management are doing a great job, has been paying that dividend 68 years without cutting it, and it's still very safe dividend as well. Down about 5% when it comes to the 1 year, a year to date about almost 6%. Looking at fast graph, for example, as you can see, it's been overvalued for quite some time, and I love this. Look at that dividend growth. Okay, they're expecting to carry on for the next whatever years. And then if we look at the forecast, for example, for this company using normal estimate, you'll be losing quite a bit of money right now. You'll lose about almost to 2,000 of your money. And if we are using normal multiples for this company, which you should use it because it is never traded anything below 23 PE or 24, so on and so on. And that's basically where it is now. So I would generally think that's normal for this company. And yeah, if you bought it right now, you will be making about 3,000 USD on top of your money, which is quite nice to know. But I would potentially wait for another maybe 5% or so to be pulled back before I start looking at it again. The next one is Aluminium Foil, which is a company that's been in my watch list for a very long time. It's been on the watch list for quite some time, but dividend paying company. Again, profitability side of things really good. Free cash flow is decent. Growth is expected to grow basically double digits in terms of EPS, which is nice, but it seems a little bit expensive right now. And looking for the 1 year, it's about 6-7% down for the 1 year. Year to date, about 5% down. Looking at this, you can see the company, basically the stock price can be trading the earnings for quite some time, then completely gone up and then came back down in 2018. Then it gone up again and then it came back down in 2020, and then since then it's been going to the moon. Look at that. But this is the earnings and this is the price. This is the problem. You cannot, the price is supposed to track the earnings of the business. If the business isn't basically doing decent, but the price is just gone too much, eventually, okay, it's going to reverse to the mean, which basically means that it will come back down to meet this, because this is the expectation. This is what this is reality. This is not reality. So yeah, let's see. For the last 10 years, if you look at it, look at that. It's been basically overvalued for the last 10 years. Now, if you look at the forecast moving forward, as you expected, if you bought it right now, you'll be losing about 4,000 basically of your money. If you buy it, if basically, and think the normal PE is what we should be using, which is very, very high for this type of business. If this was a very high-tech company, I would say, yeah, maybe is warranted that to have that not basically higher PE multiples, but not really, not this one. Okay, if you bought it right now thinking the normal PE is absolutely fine, you would be making about 2,745 on top of the money that you've actually invested, your 10,000. So that's the 7 companies I wanted to share with you guys today. All of these companies have come down quite a lot, but again, this shows you how overvalued the market still is. These companies, some of them are down so much and it's still overvalued. So you have to be really careful. Whenever you see a little bit drop, people are start buying. I haven't bought anything since April because 1, I don't have a lot of cash, and 2 is a lot of the companies that I own are just overvalued right now, and that's why I don't really want to touch them. So I was hoping companies like, I would love to add to Home Depot and Procter Gamble. These are 2 companies that I genuinely would add another, say, another £5,000 on top of what I already have. But the issue is these have been expensive for a very, very long time. Okay, and this one is probably the closest. I'm doing a little bit more digging, inshallah, the next couple of days, and see the earnings, where it's going, what is happening in the next few years. You know, because if we go back here, one of the things I normally look for is just to look at the next 3 years. For example, we're expecting in 2026 about 3%, but 2027 is 7% and then 6%, which is basically what the company does generally. Okay, so that's 7% to 10% is what I would like to see more of, and potentially I might, just because of that, I might actually start nibbling and just add a little bit here and there. But let me show you the Sharia compliant and I'll stop the video. That's the Sharia compliant side of things. Pause the video if you need to. All of these companies, if you use these standards, if you use Zoya, basically they are all Sharia compliant stocks. Now, if you haven't joined us in the Patreon account, where you get access to a lot of things, including the subscriber portfolio review, and you haven't shared that with me, please do so. I regularly share basically quite a few things on this one, so it will cost you about £5 or £6, whatever it is that money is, and yeah, you get a lot out of it, and it really genuinely helps the channel. I hope you're enjoying the content. Yeah, let me know if you have any questions. Have a wonderful day. Assalamu alaikum.